In a market that's supposed to have one price, silver is currently broadcasting two. On the screens, spot has been stalling and whipping around like it's trapped in mud. In the real world, premiums are rising like the metal is scarce. That's not a cute anomaly. That is the kind of contradiction that only shows up when something underneath the market is under stress. And the stress signal isn't subtle. In the late January to early February 2026 volatility window, silver suffered an air pocket move so violent it reset the entire leverage structure in a matter of hours. We're talking about a plunge, reported as large as 36% intraday, not months, not weeks. In a couple of trading sessions, the kind of move people insist can't happen in a liquid global commodity happened anyway. Here's the part most people miss. When a move like that hits, the first thing that breaks is not the metal, it's the plumbing, the margins, the financing, the ability of certain players to keep positions open. The public sees a chart, institutions see a stress test, and when the plumbing breaks, the market starts telling the truth in a different language. It stops being a single number and becomes a spread. Spot on one side, premiums on the other, paper value versus physical value. That is the language silver is speaking right now. What I'm about to walk through is not opinion, and it's not a rumor. It's a pattern, and it's measurable. It's also the kind of pattern that historically doesn't stay quiet for long. The last time we saw these ingredients line up, violent deleveraging, exchange level margin changes, and physical premiums refusing to cooperate, the next chapter wasn't a smooth return to normal. It was a repricing of how the market decides what silver is worth. Welcome to Signal Ledger, where we decode what matters before it becomes a headline. If you like analysis that follows the mechanics instead of the noise, stick around. Consider subscribing the way you'd keep listening to that one calm voice in the room when everyone else is shouting. And tell me where you're watching from, because this story looks slightly different depending on where you're buying, selling, or trying to source physical metal. Now let's reconstruct what happened with forensic clarity, because the details are the whole point. After the late January shock, the exchange infrastructure responded the way it always does when volatility spikes. It tightened the leash. The CME raised margin requirements on COMEX silver. For traders not classified under heightened risk, margin moved from 11% to 15%. For those classified as heightened risk, it moved from about 12.1% to 16.5%. That isn't a headline. That is a lever. And when the exchange pulls that lever, it forces a specific kind of behavior from the market. Margins are the gatekeepers of leverage. They determine how much capital a participant must post to hold a position. When the margin requirement jumps, the same position suddenly requires more cash. Not later, now. If a participant can't post the additional funds, they reduce exposure. They sell, they liquidate. They don't do it because they change their mind about silver. They do it because the rules changed under their feet. This is why a crash followed by margin hikes can create a second wave of selling pressure. The first wave is fear and stops. The second wave is forced compliance. In reality, a large part of it is the mechanical outcome of a leverage constraint. But here is where the central mystery enters. While paper silver gets slammed by the mechanics of margins and liquidity, physical silver does not necessarily follow. Physical silver has a different constraint: sourcing, availability, fabrication, delivery. The real metal can be sitting in a warehouse, a vault, a pipeline, or in the hands of owners who don't have to sell today. So what happened next is the contradiction that matters. Spot stalled and hesitated, digesting the paper shock. Yet physical premiums, what people actually pay over the spot quote to acquire bars and coins, stayed stubborn, and in many channels, they rose. In the retail-facing market, certain widely recognized products were listed at premiums that aren't $1 or $2, they're double digits. Think $15 per ounce over spot, and in some cases closer to $18, depending on packaging and availability. Let's be precise about what that implies. If spot is, say, 20-something, and the premium is 15, the buyer is effectively paying mid to high 30-something for an ounce that the screen claims is worth 20-something. That's not a small friction. That is a parallel pricing system. There's also a geographic layer to this dislocation that most screen-based analysis misses. Wholesale liquidity clusters in a few hubs, but demand is scattered across thousands of smaller channels. When stress hits, metal can move, but it cannot teleport. A buyer in one region can face delays and higher premiums, even while another region looks better supplied. Taxes, shipping costs, and preferred products add friction. The result is that two people can quote the silver price and both be correct because they are describing different layers of the same system. Notice what that does to perception. A stalled spot quote makes the wider public feel like nothing is happening. Meanwhile, anyone trying to source metal encounters a different reality: limited inventory, longer lead times, and a premium that behaves like a bid for immediate access. That lived experience is what turns a quiet dislocation into a loud one, because people don't wake up from a 1% move on a chart. They wake up when the posted reference price no longer buys the thing it claims to price. And parallel pricing systems do not emerge in healthy, well-clearing markets. They emerge when the posted reference price is not doing the job of allocating supply to demand in real time. This is where people get trapped by the wrong question. Those questions miss the mechanics. Premiums are not a moral statement. They're a pressure gauge. When premiums rise while spot stalls, the market is telling you that the bottleneck is not interest in silver. The bottleneck is deliverable silver in the form people want, where they want it, right now. Now I'll step back, because this isn't the first time silver has spoken in this language. In 2008, in the middle of the global financial crisis, paper markets seized. Liquidity evaporated, prices whipsawed. Yet physical demand surged in pockets because trust in the system was breaking. Dealers ran out of product. Premiums shot up, even as screens showed panic. Result, once the forced deleveraging phase ended, silver didn't simply drift back. It entered a powerful multi-year run that culminated in a dramatic peak a few years later. In 2011, after silver's explosive move, the exchange used margin changes as a tool to cool speculation. Margin hikes cascaded across participants. Price action turned violent. The paper market corrected hard. Yet the episode cemented a lesson. When leverage is concentrated, exchange policy can change the game overnight. Result, volatility became the defining feature, and physical buyers learned that the number on the screen is only part of the price. Then in 2020, during the early shock of the pandemic era, we saw a modern version of the same playbook. The paper price could move down or freeze in certain moments, but the ability to obtain physical metal did not move in sync. Premiums widened, supply chains strained, mints and refiners faced disruptions. Result, the spread between spot and physical became the headline for anyone trying to actually buy metal, and it took time for production and inventory to normalize. In 2026, it's happening again. A sudden volatility shock, an institutional response through margin policy, and a physical market that refuses to price silver like nothing happened. This is not a conspiracy, it's a stress pattern. And once you recognize it, you stop looking for a single villain and start watching the actual players and incentives. So who are the players? First, you have the exchanges and clearinghouses, the rule makers for leveraged trading. They decide margin levels. They decide what counts as heightened risk. They enforce the capital rules that determine who can stay in the game when volatility hits. When the CME raises margins, it isn't issuing an opinion about silver's long-term fundamentals. It's protecting the integrity of the clearing system. Second, you have the commercial hedgers and industrial participants. Some use futures to lock in prices for production or consumption. Some offset exposures. Their behavior tends to be less emotional and more tied to cash flows. But even these participants can be affected when volatility spikes because the capital demands can rise at exactly the wrong time. Third, you have the large speculators, funds and traders who seek returns from price movement. They often use leverage. They often concentrate in similar strategies. When margins rise, they are the ones who feel the squeeze first because their positions are designed to be capital efficient until suddenly they are not. Fourth, you have the bullion banks and market makers, the entities that stand between flows. They provide liquidity. They facilitate hedging. They also manage inventories and exposures across products. Their job is not to root for a higher or lower silver price. Their job is to survive and profit from spread, financing, and flow. Fifth, you have the physical supply chain, the refiners, mints, wholesalers, and dealers. Their world is not mark to market every second. Their world is shipping times, fabrication capacity, premiums, and inventory turnover. If demand spikes and they cannot replenish inventory quickly, the only tool they have is price. That's the premium. And finally, you have the vaulting centers, the places where large pools of metal are stored and moved. London is a key hub. And the vault data there matters because it offers a window into the real, physical base that supports parts of the global market. At the end of January 2026, reported London Vault silver holdings were roughly 27,729 tons. That's a number so large it's easy to ignore. But the percentage change matters. The figure was down about 0.3% from the prior month. To a casual observer, 0.3% sounds like nothing. In a market that can flip from surplus to tightness on marginal flows, it can be the difference between smooth delivery and a scramble. Here's how to translate that into reality. A vault number is not a pile of metal sitting there waiting for you. It is an accounting of bars in a location, many of which are already spoken for, pledged, or held for specific purposes. When holdings decline, it can signal that metal is leaving the system. It can also signal that the buffer is shrinking. Now combine that with the premium behavior. If the physical market is charging more for immediate product, that suggests scarcity at the retail or wholesale level. If vault holdings are trending down, even slightly, that suggests the buffer is not expanding to meet demand. And if the exchange is raising margins, that suggests volatility is high enough to threaten the leveraged layer of the market. Those three together create a setup where paper can look weak while physical is strong. That is the dislocation. Let's name it clearly. Two markets are telling opposite stories. On the paper side, you have spot and futures responding to liquidity, leverage, and margin constraints. A margin hike is like a sudden narrowing of a highway when traffic is already moving too fast. Cars slam the brakes, pileups happen, prices drop, not because the destination changed, but because the road did. On the physical side, you have real people, businesses, and institutions trying to obtain specific forms of silver, coins, bars, industrial feedstock, through a supply chain with finite capacity. When demand increases or supply tightens, the pipeline cannot instantly respond. Premiums rise to ration inventory and to pull supply forward. This is why the paper price can stall while premiums climb. The paper market can be dominated by forced sellers. The physical market can be dominated by reluctant sellers. And reluctant sellers demand a higher price. There's another layer to the dislocation that rarely gets discussed because it's uncomfortable. The paper market trades claims. The physical market trades objects. Claims can multiply faster than objects can be produced. When the system is calm, that multiplication is treated as liquidity and efficiency. When the system is stressed, that multiplication is experienced as fragility. Think of it like airline tickets. In normal times, an airline can sell a huge number of reservations because it has a system that usually delivers seats. But if something disrupts flights, the number of tickets doesn't create new planes. It creates a problem. The scramble is not about what the ticket says, it's about the physical seat. In silver, a similar dynamic can appear when paper positioning is large relative to deliverable supply. If a stress event forces participants to demand delivery or to reevaluate counterparty risk, the system doesn't instantly break, but spreads widen. Premiums rise. The market starts charging for certainty. This is why premiums matter more than most people think. They are the price of certainty. Now let's walk through the mechanism of how this kind of dislocation gets executed, because it's not mystical, it's mechanical. Start with the volatility shock. A large intraday plunge can trigger stop-loss orders, margin calls, and risk-off behavior. That's the first domino. Participants who were leveraged see their equity shrink. They may have to post more collateral immediately. Then comes the institutional reinforcement. The exchange raises margin requirements. That's the second domino. Even participants who survived the first wave now face higher capital demands. If they can't meet them, they reduce positions. That becomes forced selling. Forced selling is not price discovery in the traditional sense. It is compliance. As positions are liquidated, paper price pressure can persist. Meanwhile, the physical supply chain experiences the opposite flow. Volatility can create fear and urgency among buyers who want tangible metal. At the same time, some sellers pull back because they don't want to sell into chaos. Inventory on dealer shelves gets thinner. Wholesalers become cautious. Fabricators get orders faster than they can fill them. So premiums rise. Not because the dealers woke up and decided to change the rules, but because the pipeline is trying to balance supply and demand under stress. The premium becomes the shock absorber, and when shock absorbers compress too far, the next bump hits the chassis hard. This is also why a stalled spot price can be misleading. Spot is not a measure of what you can obtain today in the form you want. Spot is a reference price derived from paper trading and large wholesale bars. It is the price of a claim in a liquid marketplace. Physical is the price of an object in a specific format, delivered through a constrained supply chain. When these diverge, it is telling you that the reference price is not clearing the retail level market. The market is clearing through premiums instead. And this dislocation cannot persist forever. Spreads can last. They can even last a long time. But they do not last without consequences. Historically, the consequences tend to show up in one of three ways. One path is that spot catches up. As forced selling exhausts itself and as participants adjust to new margin levels, paper price can realign upward toward the physical clearing price. That doesn't require a miracle. It requires the selling pressure to finish and the demand for hedging or exposure to resin at the new capital constraints. A second path is that premiums come down. If supply chains ramp up, inventories rebuild, and demand cools, physical can realign downward toward spot. This is what happens when scarcity was temporary and production can meet demand. A third path is that the market splits structurally. The paper price continues to trade as a financial instrument, while the physical price, especially for certain forms, behaves like a scarcity good. This tends to happen when trust issues persist and when the willingness to accept paper claims declines. In that scenario, the spread becomes a feature rather than a glitch. Which path happens depends on what the data does next. And this is where the evidence matters. Watch margin policy. Exchanges don't raise margins for entertainment. If volatility remains elevated, margins can stay high. That keeps leverage muted and makes explosive paper rallies harder, but it also reduces the fragility of the system. If margins are later reduced, it can reopen the door for leverage and faster price moves. Watch inventory and vault flows. When large vault holdings trend down, it can signal that metal is being pulled for industrial use, for investment demand, or for relocation. The absolute number can still be huge, but marginal flows drive tightness. Watch retail and wholesale premiums. Premiums are the real-time indicator of stress or ease. If premiums remain elevated while spot stalls, the dislocation persists. If premiums compress, supply is catching up or demand is fading. Watch delivery pressure and the behavior around contract expirations and delivery windows. You don't need to be a futures trader to understand this. When more participants want metal delivered rather than cash settled, the system has to either provide metal or provide incentives not to ask. Incentives can take the form of spreads, financing, and premium dynamics. Now, what does all of this mean going forward without turning it into a prediction? Historically, when silver experiences a violent deleveraging event followed by persistent physical premiums, the next phase tends to be unstable. Not necessarily directionally obvious day to day, but unstable in structure. The market is deciding which layer is in control, the paper layer or the physical layer. If the current stress signals continue, if volatility remains high enough to keep margins elevated, if physical premiums stay stubborn, and if vault buffers do not expand, then historically the market tends to move toward a repricing event. Sometimes that repricing is an upward catch-up in spot. Sometimes it is a prolonged period where the street price remains divorced from the screen price. Sometimes it is a sharp spike, driven by a sudden scramble for physical liquidity. A conservative scenario is that the system normalizes. Volatility cools, margins eventually relax, supply chains catch up, and premiums compress. In that case, the dislocation becomes a memory, and the screen price regains its role as the dominant reference. A moderate scenario is that the dislocation lingers. Spot trades choppy and range-bound while physical remains firm. Premiums become the pressure gauge everyone watches. The market feels like two separate arenas, and participants learn to respect the difference. An aggressive scenario is that stress escalates into a credibility problem. In that case, the market starts charging a persistent premium for immediate, verifiable metal, and paper pricing becomes less relevant for certain buyers. Historically, that's when volatility returns in a new form, not just in spot, but in spreads, availability, and behavior. The key is not to guess which scenario will win today. The key is to watch the indicators that historically change first: margins, inventories, premiums, and the cadence of shocks. Because there's a divide in every market event like this, not a divide between smart and dumb. A divide between those watching the headline price and those watching the plumbing. The headline price is seductive. It's a single number. It feels like truth. But in stress periods, truth moves into the spreads. The market reveals itself in what it charges for certainty, not in what it quotes for liquidity. Institutions always move first because their constraints are enforced first. When margins rise, they have to respond. When liquidity evaporates, they have to adjust. Retail reacts later, not because retail is slow, but because retail receives information later. By the time the average person notices a dislocation, it has often been in motion for weeks. That's why this moment matters. Silver premiums rising, while spot stalls is not just an interesting trivia fact. It is a signal that the market is not fully clearing through the paper price. It is a signal that somewhere in the system, there is a preference for the tangible thing over the claim on the thing. And when that preference becomes widespread, the market changes its behavior, the rules become more visible, the costs of leverage become more punitive, and the calm assumption that price is price breaks down. This is signal ledger, where we decode what matters before it becomes a headline. If this connected dots you hadn't seen lined up, margin policy, vault flows, and premiums acting like a lie detector, you know what to do. The question isn't whether the market resolves this dislocation. The question is whether the resolution happens quietly or all at once.